This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
South on an April of 142!
Warren Buffett.
Carl Icahn.
John Templeton.
Buy low, sell high. Fear, that's the other guy's problem.
Dan Druckenmiller.
George Soros.
Paul T. Jones.
Peter Lynch.
I wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
My guest for this episode is one of my all-time favorite technical analysts. Helene Meisler started her career on Wall Street in the early 1980s, when a career on Wall Street was actually a contrarian move, let alone being a woman on Wall Street. She eventually found her way to working with trading legend Justin Mamis, and has been charting the markets by hand ever since. Yes, that's pencil and paper for the past 30 years. In this episode, Helene reveals what it was like to work with Justin and what the most important thing she learned from her mentor. We discuss her favorite stock market indicators and how she uses them. Finally, we discuss her favorite trade setup and the unique self-awareness that she's cultivated to help her become the most effective trader she can be. As always, I put up a number of links and charts at thefelderreport.com, and I really hope you enjoy my conversation with Helene Meisler. Helene, welcome to the show. It's really, I'm really excited to talk to you today. It's actually kind of strange to, get to know somebody, online that you haven't really talked to much in person. But after following you on Twitter and, reading your daily column, it feels like I know you, but it's really nice to have a chance to chat with you like this.
Nice to be here. Thanks for having me.
Absolutely. Well, let's just start right with the beginning. I know you have an interesting, background in the industry. How did you actually get your start in finance?
Oh, well, I started my life after college in marketing, working for a marketing research firm, and this is a long time ago, it was the early 80s, doing taste tests and statistical analysis on product placements and stuff like that. And I was actually quite bored. I thought I was going to like it a lot more than I did. And I decided to look for a job elsewhere. And a headhunter I was working with, I told her I figured advertising would be a good segue. And she said, no, you should be going to work on Wall Street.
So you said this was the early 80s? This
would have been 1982.
Oh, so the exact bottom, or, the best buying opportunity in our lifetimes. So that would have been a really contrarian move, though, right? I mean, that was the death of equities cover.
It was, I guess, about a year after that. But I mean, I knew nothing about stocks and bonds. I don't even think my parents owned any. And this woman insisted that Wall Street was hiring, and she thought I would be great working there. And so she set me up on several interviews, and I will never forget my first interview at Cowen, which was my first job, was the Wednesday before Thanksgiving at 4:00 in the afternoon. And I was like, you had all these interview rules: never interview Monday morning at 9, never interview Friday afternoon at 5. This was like the ultimate of who is going to hire you.
Right. Yeah.
With this hour. But of course, you didn't realize that the market closes at 4:00. And anyway, they made me an offer, and I went to work there. So
this was Cowen.
This was in Cowen.
What were you doing specifically for them?
I was an institutional sales assistant, which was, I don't know, sort of a glorified administrative assistant, I would call it, in that. But I worked for the partner in charge of the New York office. So, the market was just taking off. And as things got busier, he kept dumping more stuff on my desk. And, I had to learn as I went. So I was very lucky in that I was in the right place at the right time.
Okay. And, and probably with the marketing, background, it wasn't too much of a jump to move towards, institutional sales.
No, but institutional sales was not necessarily about sales back then. I mean, back then, the analysts on the institutional buy side were the people you cared about, not even the portfolio managers. You only cared about the analysts. And so, I mean, I'll tell you what, I look back and I think, although I probably thought it at the time, but I was learning so much, I didn't scoff very much. But
Right.
I look back and I say, God, they were some of the most boring calls you'd have to make.
Yeah.
It would be like, hi, we're raising our IBM estimate by a nickel due to a lower tax rate, and we're still recommending the stock.
Yeah.
But
Well,
you
and
make enough of those calls, you learn the story, you learn what moves stocks,
So that was good experience from that respect, to see kind of behind the curtain Wall Street.
Oh, yeah. That's the way it worked back then. And then there was a shift probably as we moved into the middle 80s where analysts on the buy side no longer were the ones who voted the commission dollars, but the portfolio managers were now voting the commission dollars. And so we had to move from that sort of, we're changing the IBM estimate due to our tax rate to much more proactive phone calls to the clients.
Gotcha. So how did you go from there to technical analysis?
So I think it was about 1984 or 1985, Cowan hired Justin Mamis, who I look back and I think, oh my God, he was probably the age then I am now, and I thought he was so old. I thought he was like Methuselah. But he did a different kind of technical analysis than I'd seen before, and I just loved listening to him talk about the markets and the way he would write about the markets. And so it became, for me, an easy way to integrate his view with the sales call on the fundamental side. And in 1986, I think it was, I asked if I could spend more time working with Justin to really learn what he did. And they were very accommodating and they allowed it. So I was no longer an assistant, obviously, at that point. And I started working with Justin and covering hedge funds was the coverage, the sales coverage that they gave me. But back then, let me tell you, there were not a gazillion hedge funds, and they gave me the little ones that were managing like $5 million.
Okay. And what specifically was your, day-to-day look like then? I mean, were you talking with the hedge funds and, trying to sell them analyst picks and that kind of stuff?
Yeah, trying to exactly take your fundamental and your technical and put it together and, give them ideas, and hopefully they would trade through you and you'd get commission dollars.
Well, and so I know you've mentioned in the past on Twitter and things, how much some of your mentors have meant to you. Is Justin one of these? I know I recognize the name immediately. There's all kinds of books that, traders references. When to Sell is the one that comes to mind
Right.
immediately.
I think
Was he
it's his
really
best
one of
book.
that? When to Sell. Mm-hmm. Well, it's something that most, I think that's one of the mistakes investors, the biggest ones they make when they first get into investing is, they have a great idea of, why they want to buy something, but they don't have any discipline for getting out. So, that's I'll put a link in the notes to this episode on to that book. But was he one of your original mentors that you kind of talk about these days?
I would call him the mentor in the business for me. Yes.
And so what was the most important thing you really learned from him?
Oh gosh, I learned a lot, but I like to tell this story that when the very first night I had moved over to work full time, if you will, with Justin, he handed me a pile of charts, paper charts, and a stack of pencils. He showed me how to calculate the logarithmic scale on the charts, and he told me, go ahead and post the charts. You couldn't start until after the market closed. And I was still there at 8 o'clock at night, and I was not happy. And I was thinking, this is ridiculous. He's old. We're going to have to find a way to computerize this. Well, first of all, here I am, 30 some odd years later. I am still posting my charts by hand. And second of all, I walked into the office the next day and said, Justin, come on. We have to be able to computerize this. And he said, there is not only a certain feeling you get from putting the pencil to the paper, but from sharpening the pencil.
Yeah, well, I was going to ask you about this because I do, sometimes you tweet pictures of your hand-drawn charts. And you originally, like you said, you thought it was a joke, but what is the value? I mean, you're still doing it. So what is the value that you found in doing that? In
1996, I thought I was going to give it up. We were getting into the internet. It was still dial-up, but, all of a sudden there were charts online everywhere. And I thought, well, I could just start looking at charts. And after a month, I realized that Justin was right. It forces you to look at the action in my case. I don't know. I've never counted, but I think it's 150 to 200 charts I do a day. And that means you're not just looking at the exciting names, the names that are on the move. And oftentimes you can go through your entire pile of charts and you look at your notes when you're done and you've jotted down 3 stocks. You're like, God, that was a dull day in the market. Or, you just pick up things that you wouldn't normally pick up because certainly if you're looking at charts on a computer, you're looking for certain parameters. And sometimes those parameters don't come to light until the stock actually moves or does something. And when you're doing it by hand, you're getting a feel that there's a change taking place that you wouldn't get by looking at it online or putting in some kind of algorithm to come up with, well, if it's at the 50-day moving average line, it has volume, and all that sort of stuff happens after a stock has moved.
Yeah, so it's really getting a feel, and I can imagine what that's like. I have a list of 200 stocks. I don't go through every day, maybe once a week. But you're absolutely right. When I scan through them, I'm looking for certain, patterns and things that, I've recognized in the past. And I skip over all the ones that don't, meet that criteria. So I imagine when you're drawing each chart, it just forces you to focus on all the stocks, not just the ones that are meeting your criteria. So,
you will also tend to pick up a group move. So in other words, I don't do my charts like all the airlines together or all the drugs together. I do them alphabetically, and then I take notes. On the left side, I write down the good charts, and on the right side, I write down the bad charts. And when you're done charting, you look at it and you're like, God, look at all those drug stocks I wrote down. And you wouldn't necessarily pick that up otherwise, I think. I mean, maybe you would, but it's not how I do it.
Yeah. Interesting. I just have to ask you, I think there are probably going to be some people listening to, I have all different types, because I'm mainly a value investor, but I do, I started looking at technicals, 10 plus years ago, and find it very valuable to my process. But, there's the age old question, do technicals work because they intrinsically work, or do they work because people use them? What are your thoughts on this idea that?
Honestly, I think it's both. But I think, more often than not, everything that's known is supposedly already priced into the market. I'll give you an example. You go to that question when, you say to yourself, okay, something feels bullish here. And someone will say to you, well, what could move them? And I think, well, I don't know. If we knew, it'd be priced in.
Right.
Yeah. Well, what could take the market down? Well, I don't know. If we knew what could take the market down, it'd be priced in already. So I think that a stock chart represents everything we know already.
Yeah, and I've said, I think a stock chart represents, it's a visual representation of supply and demand in the market, but it also, represents sentiment, represents all the things that we're trying to uncover, when we're doing this type of research. So, I absolutely agree with that. The first thing I notice when I look at your charts, and it's something I try and keep in mind when I'm charting too, and I have a really hard time with this, is your charts are so simple. You have one line, you have a support or resistance or a trend line, and I just think, it just screams at me, keep it simple, stupid. Where does that
like all those charts people put out with 53 moving average lines and Bollinger Bands and all?
Oh my gosh, it's ridiculous. I don't know how you can begin. Right. So I mean, where does that come from? The simplicity.
When you're doing it by hand, that's all you've got is a pencil, a ruler, paper.
Right. And you don't want to mark the charts up too much because then you end up having to do a lot of erasing later on, right? When all that stuff doesn't work.
Big time. And sometimes I don't even use a ruler. Like if I have a nail file on the desk, I'll use that.
Yeah. So I don't mean to imply that your process is simple, though. I mean, I love the charts.
It actually is.
Well, I think it is, but then when you also, start to talk about, I think it's deceptively simple because there are a lot of things underlying your broad market view. You use, the overbought and oversold indicators, and on the surface, to a lot of people, I think this stuff might seem quite complex, but maybe you can simplify it for us.
All right. Well, I have probably, I probably never count 20 or 30 indicators I look at on the market on a daily basis. And it's a wonderful thing when all the indicators pretty much say the same thing at the same time. Yet that probably happens once, maybe twice a year. So, to get that kind of, oh, wow, this is it, you don't really get that often. But I like to use an overbought, oversold oscillator, which the one I use is pretty old-fashioned. Most people today use stochastics or RSI or there's a few others I don't really know about. But I use the 10-day moving average of the net of the advanced decline line, which basically it tells you what the majority of stocks have done for the last 10 days. And if the majority of stocks for the last 10 days have been down, meaning I've got a lot of red, more decliners than advancers, then I'm getting oversold. On the other side, if the last 10 days have been predominantly positive, I'm getting overbought. It's really very basic. But it's telling you, rather than based on price, which is what all your other stochastics RSI, those all are based on price. Mine is based on what the majority of stocks are doing, up or down.
So it's more of like a breadth indicator.
That's all it is. All it is. And what you're always looking for is a divergence. Did the S&P make a lower low and the oscillator makes a higher low? Well, that's a good sign. That's a bullish sign. That's
that prices are still declining, but breadth is improving.
Or sometimes it's not necessarily improving. It's just not as bad as it was.
Okay, right. So
which means you're losing downside momentum, and a loss of downside momentum is what you're looking for in an oversold condition.
And so this, in terms of the ranking those indicators that you use, where does this kind of fall in that process? Is this like one of the most important things you look at?
Gosh. Well,
I mean, like you said, you want them all to line up at the same time. That's ideal. I guess I asked this because I just interviewed Tom McClellan recently. We were talking about, he uses very similar, indicators to assess the breadth and the momentum of breadth in the market. And it just seems to me that this is something that's very important that, like you said, a lot of people are looking at stochastics and RSI. They're not necessarily paying such close attention to something like this.
Well, I think we've got two things going on here. One is as more and more people trade just the index as opposed to stocks, probably oscillators based on price are going to look different than an oscillator based on breadth.
That's what a great point, because this huge push to passive that we've seen, and that's the question that I asked Tom was, how does that affect these advanced decline ratios and things that we're looking at? Because when money's flowing into all stocks in the indexes essentially equally, or based on their market cap, does that devalue these indicators?
It can, but again, you can see changes. Like for the longest time, let's call it since March until early June, I have thought, despite the fact that the cumulative AD line has gone up and therefore breadth has sort of kept pace with the S&P, I have thought there's too many stocks lagging. And it's a very hard thing to describe without having an absolute statistic to show you. But if you sat over my shoulder and looked at the 200 stocks I post every day, you'd know exactly what I'm talking about, because you had so many stocks that just went nowhere. And it's very hard to describe that when you probably have, I don't know, a decent number of stocks that are up a nickel a day. Well, a nickel a day is not making you money. And overall, if they're up a nickel today and down a dime tomorrow, overall they're down. But you're not going to get that from a statistic. It's very hard, which is why I also pay attention to the number of stocks making new highs. Because if that's dwindling, well, what does it say when 100 stocks are making new highs and the S&P is at new highs? That tells you how hard it is to make money on the upside.
Yeah, if you're not in the fangs, you're not making money.
And it's not just the fangs. I mean, you had Visa, you had Home Depot, you had a lot of stocks that were doing that, but it was still fairly narrow.
Right. Well, and to me, that was something that I think was kind of nagging me when I asked Tom that same question, because the advanced decline line is making new highs, but I like to look at the ratio of the equal weight S&P to the market cap weighted S&P. And that ratio has been falling, pretty dramatically. Actually, in rare form, we haven't seen it much in the last, to this degree in the last 10 years. And to me, that just screams that a lot of these other stocks in the S&P are just, like you said, they're falling off. They're not, like they might be rising, but they're not rising nearly as fast as the top companies in the S&P 500. So. So and I thought you were going to tell me, Jesse, don't rationalize an indicator. When I talked about it, because I know that's one of your favorite sayings, and I think of that all the time too.
But it's true. It's true, which is why I'm not going to rationalize the advanced decline line. But we go back to I hand post the charts, so I can tell you that a portfolio manager who's managing a portfolio of stocks is probably not loving, well, up until June, was probably not loving the market.
Right.
Because you really had to be very concentrated.
Yeah. And,
but in early June, that changed. We started to get a lot more charts improving.
Okay, and what does that tell you? That we're starting to catch up now?
Well, that was one reason that I first saw that the Russell looked to me like it was going to start outperforming the Qs. Right,
and that's another ratio that you look at for basically just determining the overall health of the trend. Is that right? When the small caps are underperforming, that's unhealthy.
Well, I just think that when small caps are underperforming, regardless of what the advanced decline line is saying, that you tend not to get a great market. You tend to get a market that either goes sideways or has like one big spurt up over 2 days and then does nothing. And the majority of stocks just dribble. at least in a market where the Russell is outperforming, you can have a better chance at finding good stocks that are moving.
Right. And yeah, because it's the overall trend is healthier, and so that's a lot of it. I mean, this is one of the basics of technical analysis, and I think this is for a lot of people to understand, is just understanding the overall trend and momentum of that trend is kind of the first step, right? And for me, that was huge. I think, as a value investor, looking at stocks that are falling rapidly a lot of times and dropping out of favor, just understanding the overall market trend and then also the momentum of that name helps to avoid, as Paul Tudor Jones said, getting annihilated by technicals, annihilated by momentum. So you also use the McClellan Summation Index as part of understanding that overall trend too. Is that right?
Right. And so if we go back to the advanced decline line, shouldn't we say the cumulative advanced decline line is making new highs, or at least close to it? And the McClellan Summation Index, which is essentially like the third or fourth derivative of the advanced decline line, it can barely get out of its own way. I mean, to me, it's like a longer term oscillator. And if your longer term oscillator can't get out of its own way, I think that tells you that the majority of stocks are not being able to get out of their own way either.
And so that's has you concerned about the overall momentum of the uptrend currently.
Well, it tells me that we've not, to get it. This is my view. Obviously, others don't always feel this way, but to me, the best thing the market can do is always is clean out weak holders. Just a decline, even if it's not huge, but the decline like we had going into the election last year, enough to clean people out where the weak holders are gone. And then you can have a good uptrend that's solid, that feels like it's going to go up every day and feel like you can grasp a trend. We just don't have that now. And I don't think we've had that since February or March.
Okay.
And so to me, that's what the summation index is telling us. And that to me is because we've not had a good clean out. Okay.
And, and that really gets to the next question I was going to ask you, which is, the one thing that I really appreciate about your process is that you marry sentiment so closely with the technicals. I see a lot of technical analysts who don't pay attention to sentiment at all, and I think it just goes. You can't really extricate the two. You talk about you get a good rally after you shake out the weak holders. Well, that's kind of a sentiment thing, right? You feel like you're towards the end of the rally. You see momentum waning, but you also see a lot of, I hesitate to use the word, euphoric sentiment, but you see a lot of people feeling really good about themselves for owning stocks over the last, few months, or owning, those big stocks you're talking about over the last few months.
Right. When it becomes too easy, like, shooting fish in a barrel, I guess is the expression. It can't be that easy. But when does it end? One doesn't know. But I can tell you that what I don't see now is I don't necessarily feel like I see giddiness. I see a lot of complacency. And there is a difference, that euphoria I don't see. But I see a boatload of complacency, as if people think, so we go down 5%. What's the big deal? Yeah, well, in a 5% correction in the S&P, the average stock is going to fall a lot more, more like 10 or 15 or 20. Right. So that turns to panic pretty fast.
Well, that's why I tweeted a CNBC poll that came out right after that, sell-off in the NASDAQ and the FANGs that we had a week or two ago. And CNBC put out a poll on Monday, asking people how they felt about it, and it was like 80% of respondents said, "This is great news. It's an awesome buying opportunity." And I thought, okay, well, that's not how you create a sustainable short-term low. But
right.
So, what are the main things you look at in terms of sentiment to try and gauge that?
Well, I've got so many sentiment indicators that I use. One of my favorites, I will say, is, and always has been, is the Investors Intelligence, because it's been around since the 60s. They are very scientific in their methodology. They have a set number of newsletter writers, and they don't poll them and ask them what they think. They read those letters every week and determine if that person is bearish or bullish. And so to me, it's probably one of the only scientific sentiment surveys that we have out there. So I put a lot of faith in that. And when that gets over 60% bulls, the market has rarely continued well on the upside.
Okay, so that's kind of one of the quantitative ones. One of the reasons I love following you on Twitter is you do talk about, this more anecdotal stuff that you're seeing on Twitter. I think you probably follow a lot more people than I do. So I don't get a lot of that. So I kind of rely on you actually to share, how are traders, Twitter traders feeling right now. And then you also, I know, watch the financial TV a lot in order to kind of understand how people are feeling. Because that's just a reflection of how traders are feeling too, right?
You get a great sentiment feel off of turning on the television. I can't listen to it all day because it just, starts to be background noise. So I have to mute it a lot. But yeah. And to me, one of the, I know I make fun of a lot of the stuff on CNBC a lot, but one of the great things is that when you have the same people on all the time, you can watch their emotions shift. And that's a sentiment tell. And you can see them react to price. I mean, you can see my pinned tweet is nothing like price to change sentiment. And when you see them shift based on the movement of a stock, sentiment is shifted.
Right, because and you probably get a good feel for I hate to bring this up. I don't know him very well, or I don't read his newsletter, but Dennis Gartman is one that people broadly have followed and got to understand his own psychology toward the market. So I think when you start picking a few people like that, and you can see how they react to different things and their process, it maybe helps understand or reflect a broader sentiment signal. Is that what you're saying?
Well, if you just take Dennis, for example, there was a time that, it probably still is, everybody thinks Dennis is a fade. Oh, Dennis. Oh, you got to fade him. Well, you know what? That's when everybody thinks that a certain person is a fade. Now I got to go the other way. Right.
Yeah. Well, I that's actually one of my favorite things to look at. Over the last 20 years, I've seen times where, the major media outlets start running headlines where they talk about Warren Buffett's out of touch because he doesn't own enough tech stocks or what have you. And to me, that's just a wonderful signal that people have gotten, the hubris level is off the charts with the fact that I'm smarter than Warren Buffett, right? So, so you look for those sort of things.
I often say that if Warren Buffett were to start buying stocks like Netflix and Amazon, that would be like me becoming a momentum trader. Ain't gonna happen.
Yeah.
And if it does, be scared.
Well, he has been buying a ton of Apple, and so maybe that is some type of a signal. He'll, like you said, he'll never buy Netflix, Salesforce.com, these types of things. But I just love that sentiment is such a big part of your process, because that's something that I've always found, valuable. And is that just, experience of seeing this stuff, over the years and seeing how it works, or where did that appreciation for sentiment come from?
Oh, I guess so. I've always been a big fan of human nature in general. And if there's one thing that we can't change, it's human nature. And, I think that people will always be scared at lows and always be happy at highs because that's how we are in our lives.
So
and how is the market any different?
Oh, absolutely right. And that's the one thing that I think, it's just, I agree with you that most of the time, the markets are effectively pricing all the information out there. But, in terms of believing the efficient market hypothesis, would we have had these massive bubbles in real estate and the dot-com bubble if markets were truly efficient? No, people would have not pushed prices to the levels that they did. You bring up a good point. So what does that say? People will always be scared at lows. People will always be euphoric at highs. What does that say about this huge push to passive investing that we're seeing? I mean, what is your take on it? Because the idea behind it is, okay, well, I'll just buy everything and I'll own it and I'll expect a historical rate of return and I'll be able to hold through drawdowns because I have a 20-year time frame. Is kind of the idea behind it. From a sentiment perspective, what are your thoughts on this big push to passive investing?
I call it there's a lot of complacency. Everybody always talks, there's a bubble here, there's a bubble there. I really believe there's a bubble in ETFs. Would I be able to time it? No. But are there too many ETFs? Yes. What you had in the dot-com era was you had all these brand new IPOs, companies rushed to market. Well, you don't have that now. Now what you have, and you don't have that same fanfare, but you have, I'll just create an ETF. I'll just create another ETF. It's sort of like every week there's 50,000 new ETFs created and ridiculous ones that barely even trade.
Right. And
it's almost like they came up with the ETF just because they had a cute ticker symbol.
Well, I think, it's, I interviewed Stephen Bregman recently, and he talks about it's just Wall Street adapting with the times, trying to find a way to profit from, this new craze. And it's just Wall Street's MO is, people want ETFs, we'll give them ETFs, so,
right.
Yeah. I want to, yeah. And so I think the move to low cost and all this stuff is a great idea for most people, but I think probably people don't realize that they're also being taken advantage of with a lot of these ETFs too that are, like you said, that I don't know if they have much value. But I want to highlight something you said before. You said that you love it when all the indicators kind of line up and give you, a strong, buy or sell signal. But you talked about the rarity of that opportunity. And I think that's something that most investors or traders don't really appreciate. They want to trade all the time. And how many really good fat pitches do you get in a year?
One or two. In terms of the market, as a whole.
Market trend, right. Yeah.
Right. I'd say one or two. I mean, in a good year, in a year where the markets are volatile, you'll get 3 or 4, 5 maybe. But that would be extraordinary.
And so, is it, obviously you have other, individual stock trades and stuff that you put on. But I mean, I think it's important to, for kind of novice traders to understand that those kind of opportunities don't come along very often, and to try and force, that's one of the big mistakes people make, trying to force things when they don't have a great setup. Speaking of that, what is your favorite, trade setup? Not just necessarily for the broad market, but for an individual stock. Do you have like a bread and butter trade?
I do, but first I just want to tell you that 20 some odd years ago, I moved from the sell side to the buy side, and I was managing money, and it took me several months to realize that just because my business card said trader didn't mean I had to trade every single day. And it was a tough lesson to learn. And I would tell everybody that that's probably the smartest thing I ever realized in my career, is that you do not need to trade every single day. And it saves you a lot of money. Trade when you see it, not because you're sitting in front of the screen.
Right, and that's just such a great point. I think I use the analogy when I was talking to Bill Fleckenstein recently, and he was talking about how little he trades, and I use the analogy of I love to play music, and so you listen to the great jazz musicians, and they're most adept at using silence. As I don't want to listen to the guys that just play a million notes super fast, right? I want to listen to the guys who know how to play here and not when not to play. And I think it's the same thing with trading, knowing when to trade and when, knowing when not to trade is just important as knowing when to trade. So,
Yeah.
So do you have, tell me about this, your fat pitch, your what's the trade you look for?
Well, I'm kind of a base picker, which means I don't like stocks when they're up. A lot of people have a lot of success trading, let's say, a stock that's up that pulls back to a trend line, buy the pullback to the trend line. And it's a terrific methodology, not for me. If I started to do that, you could be sure it would break the trend line. That's just not my style. My style is that I like stocks when they're down and out and they've been forgotten. And let's say like a former winner that nobody talks about anymore, or that all of a sudden has stopped going down and has gone sideways for months and months and months. Those are often, to me, the places that you can benefit the most.
Well, and it's probably because you're not just looking to squeeze a couple of bucks out of the stock. You're looking for a change in trend and a new. So you're not day trading. You're looking for, what, and that's a good question. What is your time frame for a trade typically?
Oh, it depends. I would say usually it's longer than a few days. Yeah. I am much better off when I buy something for an intermediate term move, which is, at least 4 to 6 to 8 to 12 weeks. And sometimes a lot longer than that. But I'm not particularly good at telling you what the next hot stock is going to be for the next week. That's just not what I'm very good at. I mean, in other words, if I like a chart and it works like in the next 3 days, that's like a miracle. It probably means sell it immediately because it's really not going to work.
Right.
But a chart that develops over time that I'm early on, which is unfortunately a curse of mine, are the ones that I've had a lot more success with over time.
Gotcha. Now,
I'll give you an example. Back in, I don't know, God, I think maybe the late 90s, I think it was, everybody was trading hot tech stocks. And I bought Amgen. Yeah. I mean, it was, nobody cared about Amgen. I think I tripled my money in Amgen. But it was plodding, like maybe went up $1 a day, maybe, when everything else was going up $30, $40, $50 a day.
Well, I think people who trade, a lot of people, I mean, there are people who've been around, but people who trade biotechs and stuff today don't know what biotechs were like, 15, 20 years ago. They literally did nothing. I remember biotechs that would just literally go sideways for years and years and years, sideways to down, until they got an approval of something, and then it would rally. It's like the biotechs of the last, of this bull market, 5, 6, 7 years. It's not something I've ever seen before, something I'm used to. But yeah, there were great opportunities in 1999, 2000 for down and out stocks. Something that I think is different than today. All of those, bricks and mortar stuff, especially back then, was just so out of favor. And I guess if you're seeing it some in the real retailers today, is retail a sector that you're looking at or interested in at all?
I am, because regardless of the fact that everybody seems to think they're dead, dying, and have one foot in the grave, one thing I think that's happened, well, a few things. I think we had a major expansion of retail after the 2008 low. There was still a lot of building out in retail. Why, I don't know, but there was. And, retail was quite hot from '09, maybe 2010, until maybe 2 years ago. And what I think we've got going on now is we've got a real sorting out of who's weak and who's strong. And eventually there will be survivors. There always are. The American consumer does just that, consumes. I don't think that they're going to only go to Amazon forever and a day. And there will be winners. So I do think that we'll start to see bases being built in retailers going forward. And the longer term winners will emerge.
Okay. But you're not seeing, many bases just yet?
I've got a few, but in terms of long term, I don't have very many longer term ones yet. No, I've got shorter term ones. I've written about a few of them. Yeah, I've written about a few of them, but mostly I think now you're just playing for trades.
Right. Okay. Why? Maybe I don't know if this is. Well, it's just something I noticed, and I. First of all, I love your process because it's exactly why I started studying technical analysis, because I'm looking for down and out stocks, and I'm looking for technical signs that confirm my idea that something's basing. So maybe that's why I just love reading your stuff, is because it's along those same lines. But what is your opinion? Why are there so few women interested in trading and finance and stuff? I mean, I can't get my wife to listen to me for 2 minutes on any of these ideas or things I'm looking at. And honestly, I'll just say, I think, women generally probably make better traders because it's easier for them to take their ego out of the process. So I'm very encouraging it. I have students here in Bend. I teach some classes, and I always love to see when women, come take the class, because it's not something you see. It's not as common as it should be. What are your thoughts on that?
I'll tell you, when I first went to work on Wall Street, you want to talk about no women. There were really very few.
What was that like?
Well, certainly we weren't even wearing slacks back then, and you had to wear a suit. A dress was a big deal because it was always a skirt and a jacket. And I also remember, I think when I went to work at Goldman, which was in 1989, I bet there were no more than 5 professional women on the trading floor of, 300, maybe?
Wow.
300 plus, I guess. It was rare to see a woman on the trading floor. And now I think you see a lot more of them. So I don't know. I'm sort of encouraged that there were more professional women who are trading and investing. And
it's going in the right direction.
I think we've come a long way.
We've come a long way, yeah. Celebrate that, but why? I don't know. I guess why? Maybe, and that's part of the the technological advance of it, is it doesn't necessarily feel like a boys' club at the office so much anymore. Generally, I think women make it's easier for me to teach somebody how to invest when they can take their ego out of it, and I think I find women are better at that than men. So
it's also I think women are better at multitasking. Yeah. And I think when you're looking at so many different markets, you're multitasking.
Right.
So I just, perhaps it's just a different way of viewing it. But so why don't more women do it? I don't know. I wish I had an answer. I don't have one.
Maybe they're just not as interested in money as us money-driven guys.
I also think there's a certain lack of security in doing it. You don't have that weekly paycheck.
Right.
Which maybe many women would not feel the confidence.
Right. It's maybe that's a good point because, guys are a little bit more risk taking generally due to our testosterone. So, that's been an interesting point. I know you have a lot of other passions outside of the markets. You're a huge tennis fan. You enjoy horse racing, and you're an accomplished baker. I see your tweets on the stuff you're baking, and I think, God, I need to go back to test that out because it looks phenomenal. What are there any of these things that have taught you about trading or investing, or have parallels outside of that, or are they just an outlet to be able to turn off that financial mind and work on something different?
Well, I don't think you really ever turn it off, so it's very difficult. I mean, I'll give you just an example. We took a drive down to visit my father-in-law this weekend, which is down near Springfield, Missouri. And, I can't help myself. The first thing I notice is, oh, look at all those help wanted signs. Oh, look at all the construction I see. Look at, you can't look at the truck traffic. You can't help it. I mean, if you turned it off, I guess you probably wouldn't be very good at what you're doing.
Right.
So I don't think you can turn it off anywhere. But there are analogies in everything that we do, I think. I mean, you mentioned horse racing, which is, I would not necessarily call it a passion, but I do like it and I enjoy it. And I think it's always interesting to, because it's a sport and sport is always interesting. And really the market is a sport in many ways. It's a team of bulls versus a team of bears. And who's winning?
Right, and I don't mind the game analogy at all. In fact, Paul Tudor Jones in the Trader documentary that was filmed in '87, he talks about that's how he got interested in trading. He was playing backgammon with his I think fraternity brothers, and they were all real competitive in different games. And one guy finally told him, hey, if you are interested in games and competition, he goes, let me introduce you to the greatest game on earth, trading futures. So I've always thought that really resonated with me because that's kind of how I look at it too. I want to just circle back to something. I mean, I've noticed in just talking with you and a lot of the things, not just listening to or reading your tweets, but during this conversation, it really seems like you have a good self-awareness. You understand what you're good at, what you're not good at. And I just think that's so critical to being successful in the markets. Is that just a function of successes and failures, teaching you what you're good at and what you're not? I mean, where does that self-awareness come from?
Oh, gosh. Well, yeah, I'll tell you something. My husband, who is a commodity trader, always says if we go to the horse races and he wins the first race, he always says, oh, it's going to be a bad day.
Right.
Because if you win the first race, chances are you're going to lose the next 8.
Right.
And so I often think back to people whose first trade or first few trades are all winners, probably don't learn as much as if their first few trades were losers.
Right.
And I feel like I learned something more off a losing trade than I ever learn off a winning trade. I learned, or at least I tried to learn, not to repeat that mistake. Whereas if I have a winning trade, I don't necessarily, sometimes most of the times I think, oh, I got lucky.
Yeah.
So,
well, it just goes hand in hand with, putting on a trade. You never want it to be too easy or feel good when you're doing it, right? If it feels good, it's not going to work out, right? It has to feel not so good. I mean, and then maybe it's just a sentiment.
Well, in the old days, you had to short on an uptick, right?
Right.
You couldn't just short into the hole. You had to short on an uptick, which meant you had to be wrong on a short.
Right. Yeah.
Right? I mean, how are you going to be right if you were shorting on the downtick? And so it never, a shorting a stock never felt good because it was going up.
And maybe that's, that just from I was head trader at a hedge fund where we had a short only fund. So I was doing a lot of that in the late 90s. So maybe that's where I get that from. I don't know.
Well, so you understand what I mean? I mean, you have to be wrong to start the trade off or it wouldn't even happen.
Right. Well, I just think that self-awareness is critical. And also looking at mistakes as, I think it was one of the Market Wizards books. One of the guys in there talks about mistakes as tuition at the School of Trading. And when you look at it that way, you do need to pay some tuition before you get somewhere. So, Helene, I really want to thank you so much for taking the time to do this. You have, been an inspiration to me, and just I've learned a lot from following and reading your stuff for the last few years. So I'm really grateful to share your wisdom with my audience.
Well, thank you so much for having me. It was very nice chatting with you.
All right. Thanks a lot.
All right. Bye-bye.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. You can follow Helene on Twitter at H. Meisler. She puts up a ton of great content there, along with her opinion on what's going on in the markets on a regular basis. But the best way to keep up with her ideas is to read her daily column. It's called Top Stocks at thestreet.com. I've put up a link to her daily column, along with a variety of other links and charts that we discussed in this episode at thefelderreport.com. I want to thank you all for listening, and until next time, buy low, sell high.
Looking good, Billy Ray. Feeling good, Lewis.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.